Good afternoon, everybody, and welcome again to the webinar. My name is Mikko Lehtonen, and my colleague's name is Gaurav Kwatra. On behalf of the Asian Bankers Association and Oliver Wyman, welcome to this webinar titled Overview of Advanced Analytics and Data in Risk Applications. Since 1981, the Asian Bankers Association has been a venue for the exchange of information about banking opportunities, learning platform, and as part of this exchange, Asian Bankers Association and Oliver Wyman are now launching a webinar on risk management. And it is done after successfully completing first webinar on this series on February 27th. We're glad to have participants registering from 10 countries for this, including 140 participants registered, including 45 financial institutions, which is a big crowd. So please, let's restart. Please get comfortable and ready to learn about the advanced analytics in risk management. To present you our speakers today, my name is Mikko Lehtonen. Once more, I'm an engagement manager in Oliver Wyman's finance and risk practice based in Singapore office. And I have experience in building risk management capabilities for my financial institution clients, both in Europe and Southeast Asia, with recently an increasing focus on advanced analytics applications.
Hello, my name is Gaurav Kwatra. I'm a principal in the finance and risk practice of Oliver Wyman's Singapore office. Over the last 10-15 years, I've focused very much on risk analytics with experience across North America, Europe, and here in Asia. And as you can imagine, over the last 2-3 years, my focus increasingly has been on advanced analytics, including machine learning algorithms and new data sources.
To introduce the company that we present, we work for Oliver Wyman. That's one of the world's largest management and economic consulting companies. We help our clients across a variety of industries and topics, and these include risk management for some of the largest FS clients in the region. And Oliver Wyman is part of the Marsh and McLennan companies. MMC is a listed company in the New York Stock Exchange, and it includes services in the insurance brokerage space, risk and reinsurance space, and human resources consulting space from our sister companies. Good. We hope, despite some technical problems that I see still on the, from the audience, that we can dive into the topic now. Now, our presentation is split in two parts. We'll first introduce some of the underlying trends and enablers behind these advanced risk applications, and after that, we'll give you some concrete examples of applications that we, as a company, have seen. And we'll leave some time for a Q&A session in the end. Now, as we all know, risk management is living very exciting times. Technology and data are driving a wave of change that goes across the banking sector and touches especially risk management. It's nearly impossible to follow any business press today, for instance, without getting constant reminders of this change that we are running through. Now, to get some clarity on this situation, we want to first pin down a couple of technology-related enablers that we see are driving change in risk management. These enablers that we will present today include machine learning, artificial intelligence, non-traditional data sources, and then advanced process automation. Let's start on machine learning. Machine learning is often used to refer to a set of advanced algorithms that go beyond the traditional regression methods. Now, we are seeing that more and more advanced techniques are being taken from the data science world and being applied then in the risk management application world. Let me first use a couple of minutes to just explain what we mean by these algorithms. So we are referring to algorithms that go beyond the traditional regression methods, we have really two kinds of algorithms that we normally speak of. We have, first of all, supervised learning algorithms that answer the supervised learning problem, where we know the output y, we have data x, and we want to build a model to, for instance, predict the y. Now here we have a set of classification algorithms that, for instance, would be able to classify whether a transaction is fraudulent or non-fraudulent. And we have regression problems that answer, for instance, what is the probability of default for a customer. Now, then on the unsupervised learning side, these algorithms are a little bit different. Here we only know the X, basically the data, but we don't know the intended output. The set of algorithms that are relevant here include, first of all, clustering algorithms. These are algorithms that could, for instance, given a data set, be able to say what are the different customer segments in the data set. And they would also include so-called association algorithms that would be able to discover from a large set of data, let's say from a supermarket's data, that people who buy product X are also likely to buy product Y. Now, you might ask, what is the difference between these machine learning techniques and to traditional regression models? Well, first of all, the machine learning techniques are much better in capturing non-linear effects and complex relationships between the variables. Second, machine learning techniques are better at coping with large amounts of data, and at some point, the traditional techniques are simply not suited for the vast amount of data that one might have. And third, machine learning techniques are also better at coping with unstructured data that can come in forms of even language. Now, another relevant concept we like to demystify in this very beginning is the concept of self-learning. Sometimes you might have heard the concept of self-learning also being applied to describe what machine learning is. We want to clarify that self-learning is often used to refer to an algorithm that basically learns itself automatically from data, and the model is done by the algorithm automatically from data, maybe without human oversight. And we don't see that this kind of a fully automatic self-learning with no human intervention would be very relevant for most of the banking applications. I think it's likely that in most banking and risk management applications, certain level of human oversight would probably still be desired. Good. Let's move on then to page 7, which describes the second driver, artificial intelligence. Now, there's a tremendous opportunity today in creation of different software capabilities, in merging and combining different software capabilities to create decision-making agents that can learn and improve over time. And this is what we know today as AI, or artificial intelligence. Now, the relevant software capabilities that often come in play here, they often build upon the decision-making logic that you would get from machine learning algorithms like pattern recognition, but they often also combine others, for instance, language processing, perception, and general logic. And as a result, you would be able to see many emerging applications, especially from technology giants and other large companies. For instance, we have personal assistants, emergence of self-driving cars, we get support for purchasing predictions, recommendations engines, and even some financial analysis, online customer chatbots, etc. So this is just an example of what's becoming more and more possible. And third, another driver that we see would be non-traditional data. Data is important to algorithms. It's like fuel for a car's engine. We need data for the algorithms. Now, more and more data is becoming available, and this partially explains also the increasing demand for these machine learning algorithms. And in particular, we see that lenders are tapping into more and more data sources to improve the predictive power of models. Now, let's first of all speak a little bit of the retail world that's shown on the left-hand side of our page here. In the retail world, we see different kinds of traditional, non-traditional data sources being used. For instance, data from transaction channels like payment records in online marketplaces, in general the online footprint and internet usage, social media data. Then we see public records as utility bills being of interest, and last mobile phone usage, including location data. And the quite concrete applications that you would have in this page would, for instance, be credit scoring based on telco provider data. Now, similar in the corporate world, we see non-traditional data sources emerging. We have things like web scraping, automatic scraping of news articles from the web relating to corporate clients, and we would have even semantic analysis of news, of annual reports, of the social media sentiment. In these cases, with help of natural language processing techniques, the algorithms would be able to come up with data that describe whether the sentiment of the news is positive, neutral, or negative, allowing relevant data to be created for, let's say, early warning signals or even underwriting. And then our fourth driver is advanced process automation. We see that many banks still have huge potential in reducing manual effort in risk processes, especially given all the advanced technologies that we mentioned so far. There are many manual tasks that are still performed today by humans that could be automated. The potential for automation is very large. In this context, we often speak of robotic process automation, or RPA, which means reducing of manual effort by creation of so-called software robots that replace tasks that are routinely done by humans, and they are especially potential for cases where the stability of the system's environment is high and the business changes needed to do this automation is low. So you would have examples, applications like reporting, data management, monitoring, testing, validation, where this shows big potential. One example application area where Oliver Wyman has seen quite a lot of this kind of automation in the risk area is stress testing. For instance, Oliver Wyman has worked on cases where the stress testing process has been industrialized from an, let's say, spreadsheet-based, more manual process to a process that's enabled by web applications, more automated data flows, workflow support from the applications. And these kinds of improvements would always create reductions in the manual work and effort needed to run the process. Let's continue then on the example application side.
Thank you very much, Mikko. So I think Mikko gave a good introduction to what we mean by advanced analytics, and now we'll talk about how it's practically being used in day-to-day decision-making in the risk management space. And if you think about what is practically happening in the market, we see applications of advanced analytics right end-to-end across the value chain, starting from targeting customers to bringing them on board in terms of AML and KYC, where advanced analytics is being used to reduce the false positives and to make AML and KYC processes more cost-effective. And these are applications that are already happening. So these are real case studies that we're talking about. These are not just planned applications. Clearly, when it comes to the lending space, there is a move towards digitizing lending and taking decisions automatically. the digitization of lending in the retail space has happened for the last few years, but we see an expansion of that digitization into the mid-market space and the commercial space as well. So going beyond the traditional retail and small SMEs. Going further down the value chain, we see models being used increasingly for account management and for pricing. And then finally, for creating intelligent early warning systems that are able to pick up news, and for collections activities. Banks have traditionally not used the large amounts of data they have available in their collections departments, and we have seen that using that data more effectively can reduce your costs in the collections department by up to 20-30%. And the advanced banks have gone ahead and implemented those changes now. What we'll do in the next few pages is really give a little bit of flavor on some of these applications, give real-life examples where we or other people have supported banks in implementing some of these applications of advanced analytics. We'll start with a few examples in the space we're calling digital lending. And the first example is from a European bank which was facing a challenge in its underwriting space. And the challenge was that still a large number of decisions require manual intervention. A large number of decisions. The bank also felt that it was declining more customers than it had to. And so they were facing these challenges, right? They knew they had a solution with them because they had very, very large amounts of data. They were very good at capturing the information, but they didn't have a good way of using that information if they decided to restrict themselves to just traditional regression analysis. So what the bank decided to do was to look at its data in a new way using new algorithms. In particular, this bank decided to use random forest techniques to analyze its existing data. And really what this technique did was, the incremental benefit this brought was, there were two benefits. One, it was able to analyze large amounts of data, which is hard to do. If you just want to run regressions, you need to structure and clean the data a lot yourself, right? And the second advantage was it was able to find insights which are sort of non-linear, which means that these are insights that apply for one small part of the population and not across the population. So, just going back to this particular case, I remember there were a couple of insights. They figured that a higher loan repayment is typically considered higher risk, but that was only true for their younger customers. For some of their older customers, a higher loan repayment actually meant the customers had mortgages and they were effectively lower risk. Right now, this kind of an insight might get missed if you're doing plain regressions, right? Another example of an insight in the SME space was, quite often banks would think that businesses with longer experience are lower risk, but again, they realize that this insight is really valid only in larger customers. In smaller customers, the length of your experience didn't matter so much. So these kinds of insights were enabled by the use of new analytics. And what the bank was able to practically, tangibly achieve was they had a band which they call the refer band, where decisions were not taken automatically, and that refer band was shrunk to half by the use of these advanced algorithms, right? So that was one example of use of advanced algorithms in the retail space, in the pure consumer space. Now I'm going to present another example from the SME space, and this is with an Australian bank which was trying to provide its customers an end-to-end digital product with almost no human intervention. And Oliver Wyman helped them build this solution and put it online. This solution allowed a customer to come online, apply for a loan, and get a real-time decision. So as a customer applied, within the next couple of minutes, they had a decision. The loan was in their bank account over the next 1 to 3 days. There was still some time required to verify the customer. And beyond creating this great customer experience, they were able to significantly lower acquisition costs. And anyone who's done lending in the SME space knows how vital it is to lower the acquisition cost. It is, if you have to tackle each customer individually with a relationship manager, the costs often become prohibitive, especially for small ticket lending. So in a way, for this client of ours, we were able to enable an SME lending, a small ticket lending product in the SME space, which was not possible unless the lending was done digitally using advanced analytics. Now, clearly to do this completely digitally, it was very important that the decision making is automated and you don't have to involve humans in taking decisions. In order to enable automated decision making, we looked for information in places that the bank hadn't looked at traditionally. So in the case of this particular customer, the credit decision was based on reading the bank account statements, but also looking at merchant payments, electronically read bank account statements from other banks, looking at online accounting packages, online marketplaces for customers who were selling goods on online marketplaces. Bringing together all this information, we were able to enable automated decision making and real-time decision making in the SME space. Right, this product has been quite a winner for our client. If across all the SME products that the client has offered, this has the highest net promoter score for our client. Next, I want to give one more example in digital lending, but this time from the commercial and mid-market space, right? We are citing this one example just to create awareness that applications of advanced analytics run beyond retail and SME, right? A lot of banks and a lot of clients, when we speak to them, think that advanced analytics is something that only the retail businesses need to think about. What we have seen here is in fact an example of a European bank which has gone ahead and automated decision making in the commercial and mid-market space. The bank was a bit cautious in doing this. As a first step, they were able to automate half of their decisions in the mid-market space, mainly taking a relatively low risk appetite. Now the bank also has clear line of sight of increasing this level of automation, moving towards automating more complex decisions by use of longer data series and by increasing their own risk appetite. We're going a little bit deeper into how this particular client was able to automate some decisions. I think to simplify what was done for our audience today, the bank effectively said, of 100 decisions that we take in the mid-market space, really half of them don't require a manual review. They're so obvious, they're so obviously rejects or so obviously approves that we don't need to think about or we don't need a human being providing oversight on those decisions. You know, that was the philosophy. The philosophy resonated with a lot of people, and it was the challenging part was operationalizing that philosophy. So really looking at the data and trying to understand how were the manual underwriters taking decisions in the past and what information was relevant from the large databases of information that the customer had. The second challenge, of course, was once you approve someone, if you remove the manual underwriter, you also need to think about how much money are you going to give. So even the limit allocation had to be automated, and thinking through how you can use your information to come up with the right limit for the customer was another challenge. And all of these challenges were overcome by using advanced analytics. I think in the end, beyond automating half the decisions, we were able to create one more interesting solution for the client, where we felt that there were a number of applications where the customer was actually eligible for a lot more loan based on our algorithms than the customer had actually requested. So we created the system of a shadow limit in the customers in the bank systems, where they would give a customer a particular limit equivalent to what they asked for, but if they knew that the customer was eligible for higher limits, then they maintained a shadow limit internally, and the customer can automatically avail of it on a real-time basis later on. So I covered a few examples from the lending space. I'll ask Mikko to now show a couple of examples from the AML space.
Good. Let's continue with a couple of more examples before the Q&A. This example comes from the compliance space, from anti-money laundering transaction monitoring. Now, the common problem in this compliance space is that the number of alerts that come from transaction monitoring systems has increased previous few years, even by a few multiples. There are a couple of reasons for this. First of all, a larger share of transactions is often now being monitored. And second, many banks now need to apply larger numbers of scenarios for this monitoring. For instance, the number of scenarios that need to be monitored could have increased from something like 5 to something like 25 or even more. So just to give an example what the scenarios could be, for instance, you can have a limit for unusual volume of ATM transactions that would create a trigger an alert. Now, this increase in alerts has caused many banks to struggle with this transaction monitoring process, creating large backlogs basically of alerts that need to be investigated, lots of manual effort, increasing number of workforce that needs to be allocated here, etc. Quite costly. Now, we refer to a particular bank, and by the way, the bank, this is a public case study that you will have a link to find more information about this. This bank implemented a solution based on robotic process automation, and the solution itself is really described by the 3 red boxes on our slide. It included intelligent segmentation, intelligent typologies, and intelligent alerts. Let me focus this on the first one, really. So, what do we mean with intelligent segmentation? Now, the data that you have on transaction monitoring is so-called very high-dimensional data. Data on transactions, has many descriptors, many fields, and also data on the client profiles has many descriptive fields. What intelligent segmentation does, it first of all kind of creates a cube of your transactions, of your client profiles, of different alerts, and then it finds segments from this cube, basically optimal segments from these cubes that allow for optimizing then transaction monitoring inside the different segments. Now, as an example, when you have very high dimensional data, this cube would be too huge to work on with, let's say, traditional modeling techniques. This particular bank and its vendor used some technique called Topological Data Analysis, TDA techniques, to do this automatically, and it achieved to have a much more optimized customer segmentation for the sake of transaction monitoring. So what you can do once you have these more optimized segments is that you can fine-tune your scenarios, and especially the scenario thresholds, based on the customer segment. So, for instance, in the ATM case, you could have customer segment where a small threshold, already $1,000, would be a trigger for an alert, but you might have another segment where this similar threshold should be much higher, and including feedback, taking into account feedback from your false positives, would even allow one to adjust these thresholds so that you don't put your thresholds in a place where it generates lots of false positives. Now, this kind of just this advanced customer segmentation and then relating optimization of your scenarios and scenario thresholds allowed this bank to find a considerable decrease in the false positives. The bank reports 26% of decrease in false positives by applications of these techniques. And this is considerable, this is significant, and this was achieved without dropping any cases that would require further investigations, which means that no true positives were dropped because of this. And obviously, from a large scale, this projected and considerable monetary savings, which would have been in the order of magnitude of several millions of USDs from the FTE efficiencies achieved. Now, let me give another case, still not from lending, but now from the collection side. In this example scenario, Oliver Wyman was working for a bank that had a large collections department. The collections department was placing more than 100 million phone calls every year. That's a large amount of phone calls. And many of these phone calls were not effective in resulting into a payment from the customer. And one reason was that there was no learning from mistakes. Some of these calls went to an answering machine, or not the right party was present when called, the phone line might have been busy, etc. These kinds of calls are not efficient. Now, the approach to solve this problem was to extract, first of all, large amounts of data from this process. This enters now the world of big data. A number of 4 billion records of data were extracted from this process. The data was very rich. Data was partially unstructured, and up to 1,000 variables were extracted from here. And new features were created, and a machine learning problem was defined. Which calls are effective in triggering a payment? And like that, the team was able to analyze dozens of different algorithms, choose the ones that are most predictive in resulting into a payment, and design an automatic caller strategy based on that. Now, the impact of this new calling strategy was then a considerable reduction in the number of calls to 30 to 40%, and resulting into a 20-30% savings of cost base from collections. Now, I think we have spent enough time explaining our example case studies. We'd like to now spend a few minutes taking questions from the audience. So please type the questions that you might have into the Griddo platform. There's a text box down there, and we'll do our best to answer. We'll do our best to answer them together with Gaurav.
Maybe you can just type. Please send your questions now.
And while waiting for the first question, maybe let me take briefly the first one. Main difference between machine learning and AI. We like to think of it as quite simply in the scope of this work. With machine learning, you can think of a set of algorithms that are more advanced than, let's say, basic regression methods. They learn from the data. Artificial intelligence is a bit more than that. So, in addition, artificial intelligence would have different kinds of software, basically software capabilities as well. Often it would have capabilities in language processing, like understanding speech, processing speech, creating speech, but also, let's say, self-driving car would be artificial intelligence. You would have perception, perceive your environment, and you do decisions to stay on the road.
Okay. I think I saw another question which spoke about legal and privacy issues with new data sources. I think that's an excellent question. And why don't I share a couple of examples? So there are the two most commonly used non-traditional data sources we see are there's telco data, and then there is data from e-commerce platforms and accounting softwares. Now, clearly, especially in telco data, the challenges around privacy and legal constraints have been higher. In most jurisdictions beyond the banking regulator, the telco regulator also gets involved. What we have seen is we have seen varied degrees of use depending on the strength of the privacy laws in the particular jurisdiction. There are in China, for example, data privacy laws probably are not as strong, and we see a lot more application of telco data in applications from targeting to underwriting to collections, right? In Europe, where privacy rules are a little bit more strict, we see a more restricted use of the data. So, focusing mainly on targeting rather than on underwriting, where privacy becomes, and collections especially, where privacy becomes a much larger challenge, right? So there are restrictions on the applications that you can use the information on, and the restrictions depend on your particular geography. Secondly, obtaining this data will require you to think through all the legal processes and all the operational processes as well. Even if you use it for the simplest application, you still need to get the customer's consent to use the information, right? So you need to work with your telco partner or to do that. If I think about data information sources such as e-commerce players, there is we have seen a larger use, because quite often e-commerce players are selling to their own customers, and there are good contracts between them on sharing of information and then using that information for different applications. So really the answer varies from one application to another, one jurisdiction to another, one data source to another. What we would recommend is you think about the application that's most high value for you, and then try to find the right solution for that application.
A follow-up question on, do banks purchase this data from telcos?
Good question again. We have seen different models emerge. There is a model emerging where telcos would almost act like a bureau and sell this information. Is it the most common model? No, but it has been implemented in places. Also, there are other models emerging as well. Sometimes, I haven't seen this in application yet, but I have seen conversations between banks and telcos, where banks support telcos in the telcos lending through their own balance sheet. So telcos implicitly do a lot of lending in the form of providing handphone subsidies or giving customers advances, and banks can provide the balance sheet to back this, right?
Okay, we have a question regarding cases 2 and 3 about the ticket sizes.
Sure. Sure. I think cases 2 and 3 are from different segments. In case number 2, the focus was in SME. The ticket size, and this here we were trying to enable online unsecured lending. So the ticket size here was up to 100,000 Australian dollars. I can just go back and confirm the number. In case study 3 from our European example, where lending was actually enabled or lending decisions were automated in the mid-market space, the limits went up to $5 million US, and this was done both for unsecured and for secured products.
Yes. Then a question about, we compared benefits of artificial intelligence versus manual process. What about comparing to existing models that are currently used there? That's a good question, thank you. The benefits of this, let's say, what we call machine learning algorithms or more advanced analytical techniques, they depend on the case. For instance, in the case for AML, transaction monitoring, the benefit from this topological data analysis was really to create to use very high dimensional data and to have an automated way to create this optimal segment. The high dimensionality of this data means that you can be very, very granular with how you classify your customers, how you classify your transactions, and how you merge these into segments. And if you don't use more advanced techniques than, or if you don't use, let's say, quite advanced techniques, the problems are quite hard to manage. Now, what we call here as the advanced analytics techniques are able to get the job done with limited human intervention to come up with a significant reduction in complexity and coming up with a number of segments that are basically that can then be optimized for your scenarios. So working with the same amount of high dimensional data would be very hard in the, let's say, more traditional models.
And just to clarify here, we're not saying that you cannot achieve automation with traditional regression-based models. You absolutely can. The question is, so the two big insights here are, number one, take the same data set and instead of applying regression, apply some of the more advanced techniques. You'll be able to get higher Ginies that you would get from your traditional regression model because you're able to find insights, non-linear insights that your regression model is not able to find. So the degree of automation you can achieve would be higher. The second insight here is there are going to be spaces where there are more data sources. Again, you can use regression, but for some new data sources, for some unstructured data sources, it's going to be very hard to use regressions, and that's why these new techniques can be applicable. We ourselves are careful in asking banks to just moving to machine learning algorithms everywhere. We shouldn't do it just for the sake of becoming a machine learning algorithm enabled decision. The idea is where you see value, use them. You shouldn't apply them everywhere because there is additional complexity in maintaining them and managing them.
That's right. What should be avoided is too much of a technology push. What you want to have is more business pull. From business side, identifying which applications you would get highest benefits from, let's say, higher Ginies, higher predictive power, more automation, and then see when implementing solutions for these problems, being open to consider both the, let's say, traditional modeling techniques, but also many others that are available today.
I think I saw a couple of questions scroll through. We'll try to go back to them. I see a question about the shadow limit. I'll just elaborate on that, and then we'll go back to another question about RPAs. So on shadow limit, this was done very simply. I think this goes back to case study 3, where decision making was automated in the mid-market and commercial space for a bank. And the shadow limit was something as simple as the customer asked for $2 million. We, based on our algorithms, thought that the customer was actually eligible for up to $4 million. What was enabled in the system, in the transaction banking system, the limit that was coded in was still $2 million. A separate limit of $2 million was stored in the loan origination system with an expiry date, saying that if the customer comes for another $2 million before this expiry date, no need to go through underwriting again, simply approve it. Right? Hopefully that answers the question on the shadow limit. I think there is another question on RPA. I think you asked a very important and philosophical question. So if you are able to reduce the requirements that you have for personnel, what do those people do? And this is clearly a very important question, right? Oliver Wyman has a whole effort around thinking through the workforce of the future. For now, what we see happening is we see less of downsizing and more of reskilling, right? And the reskilling depends on the specific situation. It's hard to say, have a one answer for every situation. But I think there's definitely need to think about what will the workforce of the future look like? What will happen to my current people? We see some shifts happening over the next 5 to 10 year horizon in the workforce. It's not going to change overnight over the next 1 to 2 years. And a very important task that we're encouraging banks to take on is to think through this transition, not only for yourself, but also for your employees. I think we've captured this question.
Shadow limit.
You want to take on this question, Mikko?
In case study 4, there's a question whether the regulator approved the use of AI for AML. That's a specific question. don't have the answer.
Okay, so what I do have is a broader view on regulators approving models built using machine learning algorithms. It's a slow process. I don't think we have the answer on that specific case, but we see that regulators are increasingly becoming comfortable with models based on machine learning. In the past, banks started with having a separate capital calculation model and a decision engine on top of your capital model to improve your decision making. So if you look at case study 1 in our example, what the bank did was it stuck to its old PT model. But in order to have better decisions, the decision making algorithm was guided by insights from the machine learning analysis, right? But we know that now regulators are becoming more and more open to using machine learning algorithms for regulatory purposes as well. We haven't seen that approval come through yet, but there are definitely conversations happening. So what we are encouraging banks to do is to obviously take into account the regulatory challenges, but think about practical solutions in which you can. So when the regulatory approvals do come through, and which we believe will come through, you are prepared to take them on.
One of the relating topic here is the opaqueness of the models. It's quite easy to come up with a model. It's quite hard to convince all the relevant stakeholders, including the regulator, the model is doing a fine job, that the model is not using data that it should maybe, or features that it should not be using. It's true that the models are more opaque, more effort is probably going to be needed on communicating how the model works, but there are also different new ways for doing this. So if you think that something very simple than a regression model with few factors, it's easy to communicate what factors are and how they work. When the model becomes more and more like a black box, let's say from an artificial neural network, it's hard to seeing a picture of the model to know what it's really doing. One thing that banks are doing to communicate these models internally, let's say between risk and business, is simply showing how the model works. Let's say providing a small app that shows that if you change the certain input parameter like this, the output changes like that. Basically opening the black box in use and in basically basic applications to give all stakeholders confidence that the model is doing a good job and working as it's intended.
I think that's an excellent point. I would just like to add that applying machine learning models in a regulated industry like banking especially is not simply about learning a new algorithm, trying it out and rolling it out. You need to think through how will you ensure that the model remains transparent. You need to make sure that you have the the methodology to monitor the models. The methodology to update the models. You have the people trained to do that. So while this is very beneficial, we would strongly advise that you think through all the details, right? And it's not only about, which is where Oliver Wyman tends to say that you need to have people who understand both advanced algorithms and they understand banking. Right? Just having one part of the knowledge is not enough to implement all this.
If there isn't any more questions, you guys can wrap it up and just end the slides up, because I'm not sure if you have. Maybe you can just say, for those who haven't got the slides, we will send it to you if you haven't managed to hear it properly. Because they're asking.
Should we take one last question?
Is there a question?
BBB. Do bankers need to understand the inside of the box?
Oh no, you absolutely need to understand what's inside the box. I don't think in the banking space you will want to take decisions that you don't understand. So we as Oliver Wyman don't prescribe the use of black boxes. Instead, what we prescribe is analysis, the kind of sensitivity analysis that Mikko was pointing to, which will help you understand what the black box is doing.
Yes. And I think that's a good wrap up from Gaurav. I think we are approaching the end of our time then in this webinar. Thank you for all the insightful questions, and apologies once more for the technical problems we had in the beginning.
So you copy of the slide.
So the copy of the slides would be sent after the presentation to all participants. And if you have more questions to ask, if you want to continue discussions offline, you'll find our email addresses from these slides. Now, on the departing notes, we'd like to remind that Oliver Wyman publishes a number of reports regularly, provide our points of views and perspectives on key industry trends. You'll be able to access these documents. These documents, a link will be provided in the presentation. And then we'd like to remind you that the Asian Banking Association is here to help Asian financial institutions. So ABA would like you to encourage having a look at the ABA's training, meeting, conference agenda to look at different opportunities. If you have interests or questions about membership, please email ABA. And in addition, we'd like to remind that Oliver Wyman works close with Asia Pacific Risk Center, or APRC in brief. APRC is analyzing key risks that face industries and governments and societies in Asia. And Asia Pacific Risk Center also plugs into the Marsh & McLennan Global Risk Center to tap into a global network of risk management experts. And APRC is using Brink Asia, which is a online news platform, to provide digital news services. Brink Asia is really meant for executives and people who have limited time to get the up-to-the-minute, practical, concise updates about the key emerging risks and market trends relevant in Asia. I encourage you to reach out to all of these platforms as you are interested. So, on one final word on logistics, you would then receive an email from ABA coming days with also follow-up questions, and all participants who wish to receive a certificate of participation, we kindly ask you to reply to these questions by March 28. And we encourage everybody to reply to the questions. The results will be shared with all the participants of this, let's say, departing survey. So again, on behalf of Asian Bankers Association and Oliver Wyman, thank you for participating in the webinar, and see you soon again.